What if you could legally avoid taxes? That's what I want to show you how to do right now. Hey, it's Eric with Jazz Wealth Managers, where this month we have been focusing a lot on retirees, and today I want to give you really probably one of the best bangs for your buck you're going to get, and this is public knowledge. So I'm going to provide it for you right this second, save you some money on taxes, and hey, you know what? This is the kind of stuff we do around here. We're going to have a full month coming up in all of September for all of our clients when it comes to retiring. We're going to be bringing in some special guests on our private classes for clients, so come join us if you haven't yet. But all right, so there's the commercial. When it comes to saving money on your taxes, everybody wants to do it. Nobody actually wants to pay money in taxes. But unfortunately, once you hit 72 years of age, there comes a point in time where the government's going to poke their head in on your business and they're going to say, hey, you've never paid taxes on any of this IRA. You've got to start pulling money out. Well, the frustrating thing is when you get to a point in life, maybe you have a pension, you already have Roth IRAs, you've got cash in the bank, you've got all this stuff and you don't need this RMD. Well, that's what I'm going to talk about. And not only that, though, it's also for somebody if you're going to age 70 and a half and you're maybe a charitable person. This can save you a lot on taxes, and I'm going to show you that strategy. So what exactly am I talking about? Well, it's termed a QCD. It's a qualified charitable distribution. So the way this works is you're going to be taking money from a pre-tax account, such as an IRA. You can't do it from a 401k, 403b. So if you still have everything at an employer plan, you're not able to do that. But you are able to do it if you have rolled this into an IRA. The way this works, the IRS allows this, is that you're actually going to take that money and give it directly to a charity. Now, for each person, you can do up to $100,000 per year. So if you're married, you can do up to $200,000. And now, that's not for everybody, though. What I want to show you, though, is that maybe you don't want to give away $100,000 a year, but maybe you want to give away some money and you're having to pay taxes and pull money out of your IRA each year to be able to do this. Well, this is a way to maybe save you a couple bucks. So check this out. Let's go over to the handy dandy board and I'll explain exactly what I'm talking about. So if you're 70 and a half years old, the QCD can start. Now remember, when it comes to the QCD, it has to be what's called a direct transfer. So you're not going to take this money out, put it in your bank account, do all these things. You want to make sure it's a direct transfer, and you have to be very careful when you're filing your taxes. I am not an accountant. I can't legally give tax advice, but I'm telling you to speak with a tax professional on this strategy to make sure that it is done properly. And so what you're going to be doing is you're going to do that direct transfer to a charitable organization. This has to qualify. So it has to be a 501c3. Make sure that you're giving it to a charitable organization that does qualify. So when it comes to everything right here, here's the big bang for your buck. Now, when it comes to the average person, you are going to get a $12,900 standard deduction for the year if you are a single filer. If you are married, filing jointly, you're going to get $25,900 as a standard deduction. Well, if you were to take, let's just say you have $100,000 in an IRA, and you want to give $10,000 this year, let's just say, to your church. Well, if you take the $10,000 out of the IRA, now you're going to have to pay taxes on this $10,000, and then whatever is left, you're going to be giving to the church. So because the reason for this is you can't itemize if you have these high deductions. Oftentimes, people aren't going to be able to itemize. If you're able to itemize, it's a little different strategy of what you're looking at because you can actually deduct this $10,000. But if you can't deduct it from your taxes, what happens is you have to pay the tax on this first because you're already taking the standard deduction. So in this strategy, what you are going to do is you're actually going to take this $10,000 and do that direct transfer to the church or whatever organization you want. And with that being said, that is going to show up as not any income for you. You still get your standard tax deduction, but now you have no extra tax that you're going to pay on your money. And also, you were able to give them even more money because if you paid the tax, they're probably only going to get whatever the leftover is off of that $10,000. So you're able to help them. Now that's one part of this. But the second part of this is that once you hit age 72, you have to start taking required minimum distributions, RMDs, that's what they call it. So if you're having to take those and you don't need those, or maybe you don't need all of it, but you still have to take it and you have to pay the taxes, you can also do the qualified charitable distribution. Now, there's a really big thing, though, you have to be careful with, because when you're 72, the government looks at it as the first money that you're taking out of your IRA is considered the RMD. So let's just say that you wanted to take out the RMD for the year, and that was $5,000. So if you have $100,000 here in your account, you take out the $5,000 and you put it in your bank account. Now that's your RMD. But you know what? That $5,000 was actually going to go to the charitable organization. And then later in the year, you have another $5,000 that you want to take out and give to that charitable organization. Well, unfortunately, the way this is going to work is that part of this money, this $5,000 here, is going to be shown as, if you didn't do a direct transfer with it, it's actually going to be being shown as taxable income. So be very careful, and instead look at doing it together as the first withdrawal. Remember, the first withdrawal from the IRA during the year is generally what they're looking at as the RMD. So take that $10,000 and that would all go to that direct transfer. Or if you just wanted to do the $5,000 to start with as the QCD, that works. Just make sure that it is a direct transfer. So again, this is kind of a crazy strategy. It's a cool one. The IRS allows it. It is legal. It's not for everybody. Oftentimes people who are fortunate enough to have a lot of money that is in the bank account though, and you don't need the RMD, this is a way to be able to be charitable while you're living and also save on taxes. Thanks for watching. If you want to watch more FinTips videos, click here. Be sure to like and subscribe also.